businesses, over 30 years of experience across industries. He's been in market research, in consumer insights, been in media, been in FMCG, and very, very well-known brands like Times, like Kantar, like IMRB, like Kodak, and all of that. So, if you go to LinkedIn, you will see his illustrious profile. So I don't want to keep talking about that because that itself may suck up all the time. So what we'll talk of today, and Sridhar will walk us through that, is all about smart financial planning. I'll leave it to Sridhar to explain what smart financial planning is all about. But this is such a critical, crucial area for all entrepreneurs to get their arms around, to really understand how to think about structuring their businesses, how to think about planning for their businesses, and to think about the importance that they have to pay to keeping track of the financials. Most often they focus just on the product or on supplies and all of it. But at the end of the day, if the business doesn't make money or it is not structured right, it's not going to be a happy situation. So with that brief introduction, now over to you, Sridhar. I leave the floor to you, and you can go ahead and start your presentation or your discussion conversation with the audience.
Sure. Thanks a lot, Sanjay, for that generous introduction. Thanks to you and to NICE for giving me this opportunity to share some of my insights with an illustrious audience. I'm going to share my screen now. Hope you can see the presentation.
Yes, Sridhar, please go ahead.
Thank you. Good evening, everybody, whoever is on the call. Important to note that you have taken time out, precious time out of your daily routines to be part of this session. So thanks once again. What we are going to do is talk briefly about financial planning. Financial planning per se is a vast subject. Hence, we would not be able to obviously cover all aspects of it. We will talk about some of the processes and the need to track the financial plans. And if there is anything beyond that, we can always either take it in the Q&A or post the session. With that, I'll move on. So we've all been experienced, entrepreneurs or to be entrepreneurs, but we are all familiar with the concepts of business plan or a financial plan. A business plan is something which, whether it's an individual or an enterprise, an entrepreneur would need to, be ready with. If it's an individual, again, in your own sphere, in your own individual space, what kind of a plan do you want to have so that you have financial security at the end of the day is something an individual will look out at. But the moment you have some commercial aspirations, then you get into the space of realizing that you need a business plan in place. And a business plan is nothing but a collation of your entire strategy in words and numbers. So whether you look at the marketing aspects, whether you look at operational aspects, whether you look at competition, whether you look at what kind of offering you want to be giving, your customer landscape, so on and so forth. And of course, the financial plan becomes an integral part of the business plan. Now, why is the financial plan integral? Is because all these aspects which I spoke about ultimately culminate in numbers through a few key documents in the financial space, which we will see in the next couple of slides. I have borrowed this acronym of SMART because I thought it was very relevant from a planning point of view. Why it is relevant is because if we have a robust plan, it gives us the ability to be exactly these words which are outlined out here, specific, measurable, achievable, relevant, and time-bound. Now, why these are important is because a business plan or a financial plan is ultimately giving you a framework of how my vision can be translated into reality. It gives a path to action. And so if that path to action is not detailed, is not concrete, if you're not able to measure progress against it, if it is not realistic enough, if it is not aligned with the vision, and if is not time bound, it does not serve the purpose. So while there are various other characteristics which add to the robustness of a business or a financial plan, these 5 attributes of being smart really helps a lot. Moving on, one important question that could come to anybody's mind would be, why would I even need a financial plan? And when we look at several aspects of why we need it, just step back and say, what is your vision at the end of the day? You want to have a successful commercial enterprise which aligns with your vision, which aligns with your strategy, and so is able to execute and deliver what you have in mind. And so a business plan or a financial plan exactly enables you to outlay what you want to see through your plan in a manner that you are able to execute it on a timely basis. So if you already have a commercial enterprise, or if you're looking at scaling up an existing commercial enterprise, or if you're just about to start, one of the requirements that could come up is fundraising. So if you are at a stage, let's say if you're at a seed stage or pre-seed or even the next stage, a potential investor is going to first ask, do you have a business plan, and hence have a financial plan. So a pitch deck, if you typically see, would always carry a section on the financials. The other requirement that you may have is if you're not really looking for investment, but if you're looking for a strategic partner. Again, any potential partner is likely to say, first I'd like to have a look at your business plan, and then we can discuss further. And then if you have an investor or a partner, you may find the need to keep giving them updates on a regular basis. It could be whatever periodicity you would like to do that. Again, the plan comes into the picture because you are going to express what you have done against the plan. So any kind of update, even if it's to one investor, one lender, one partner, again would involve looking at the plan and talking about what you have achieved against the plan. And at the end of the day, even if you're not doing any of these, purely from an operational perspective, on a day-to-day operational basis, you are going to look at this to see how am I progressing against the plan, A, or you might need it to help you or aid you in decision making along the way. So when I look at monitoring progress, what I'm trying to say is that if you have laid out your plan, articulated your plan quite well, you would want to measure against it every month or every quarter to say, how have I achieved against the plan? And that's what monitoring the progress is all about. When you look at operational decision making, what I'm trying to convey here is to say that if you are faced with a situation, let's say 6 months down the line, 10 months down the line, that you have to take an important decision operationally, you have a fallback to say, okay, what did I plan for at the beginning of my journey? And is it in line with that? And that gives you a clear perspective of, okay, was it in my plan or not at all in the first place? If so, what action can I take? And if not, what action can I take? So it aids decision making as the journey of the plan unfolds. Moving on to now a bit more specific aspect of the financial plan. What are the key components of a financial plan? Are really 3 key documents. There may be many others which would aid these documents, but what essentially matters is an earnings statement, a cash flow, and a balance sheet. Each document serves a different purpose. An earnings statement is basically just a scorecard of telling you where are you vis-a-vis your income versus your expenses. A cash flow indicates what is the need of cash, when is it going to be required, and how am I going to source it. And a balance sheet gives you a perspective of what are my assets and liabilities, and so where is my equity or net worth standing at today. The key to all this is it's easier to make a standalone earnings statement, a standalone cash flow, and a standalone balance sheet. But if they're not aligned with the business objectives or the key performance indicators, then these documents do not have any great value as far as your business plan is concerned. Just to give an example, if your business objective was to achieve a certain customer base over a period of 2 or 3 years, or you wanted to look at a geographical expansion after a particular period of time, if your earning statement and the cash flow do not reflect that same objective, then the purpose of these documents do not really come up, because ultimately, if they're not aligned with what you had in mind from a business planning perspective, then this is not going to serve the purpose. So the key is the financial plan has to emanate out of the business objectives, out of the business planning thought process. Moving on to more specifics, here I'm talking about what a typical earnings statement would cover. So basically what we're saying is the two sides of an earnings statement, which is one, where is the money coming from, and B, where is the money going? One is in terms of revenue or income, one is in terms of costs. So when we look at the income side, essentially what is it that we're looking at as income streams are basically your revenue, which emanates out of your revenue model. And what is the revenue model all about? It's a culmination of several aspects, whether it's the value proposition that you intend to offer, both keeping the offering, customer, and competition in mind. It's a play of pricing and marketing. And it really emanates out of what line of business you are in, and hence what type of a revenue model you're going to have. So for example, if you are in a production kind of a setup, then you would typically have a transactional revenue model, kind of a revenue stream. If it is anything to do with software or something equivalent, then there is a possibility that it will be, the revenue model will more rely on license fees. Sometimes the freemium model. Freemium model is nothing but where tier 1 is priced free, and any added features or significant features beyond that are at a premium. Or it could be a subscription model where you could say that, I'm unlocking in a customer for a year, and so I have got a steady stream of revenues over the period of 12 months. Or it could be a package, whether it's if you're in the wellness sector or you are in the tourism sector, then it could result in some kind of package revenue for the business. It could be from multiple channels. It could be D2C, it could be B2C, it could be B2B in some cases. So all revenue channels are captured. And multiple streams, basically because there are possibilities of monetizing whatever content or property one has in different forms. So it could be licensing, a combination of licensing plus subscription. It could be a combination of package cost plus subscription. So it could be various models. So one needs to ensure that all streams are captured adequately. On the other hand, we are looking at expenses. Depending again on which sector we are in, the expenses would result in definitely a large proportion of direct and indirect costs. Direct and indirect cost implying that whatever cost you incur directly to ensure that the product is available or the offering is available to the end customer. There could be customer acquisition costs if you're starting up afresh. There could be platform development costs, again, sometimes significant costs, if your backbone is dependent on a platform, on a software or a platform. And there could be industry-specific costs where there are licenses required or certifications and so on and so forth. And then there are general overheads of running the business in case you have to have an office or an establishment where there's infrastructure costs. Those could become part of the overheads. So essentially, the earnings statement at the end of the day says, if my income is X and my expenses is Y, what are my margins? It's basically X minus Y. To illustrate that, I'm just looking at a simple, very, very simple example. This is a hypothetically an enterprise in the education sector. So where they offer workshops, there is content available for monetization, and they have the capability to conduct events and generate revenue. So assume that the revenue stream is generating 1750 in terms of numbers. Cost could be people on payroll, or there could be, sometimes you want marquee speakers for events. There could be costs on infrastructure because you're going to have some platform which offers content and videos and so on and so forth. And of course, marketing and some overheads. So in this case, the net position of margin is a negative 50. So this covers the earning statement in a very simple form. We now move on to what we've spoken about briefly in the form of a cash flow or a balance sheet. So here what we are looking at is if you are a manufacturing setup, then what influences the cash flow? If you're a services setup, then what influences the cash flow or the balance sheet? If you're a manufacturing setup, then definitely there is some amount of capex, likely capex, if one needs own manufacturing facilities. But today, the models on this front are so varied and so widely available that if one decides that, I do not want to invest in capex, but I want to achieve the same purpose through an OpEx model, there are providers who are willing to look at that model as well. It may, cost a little more, but it saves you the upfront cost of putting up capex. Then, of course, there is working capital. This will impact both types of businesses, whether it's a product or a service type of company. In the case of a product type of a company, there will be elements of receivables, payables, and inventory. The receivables are essentially what type of a credit policy you're offering to your customers and hence your sales. Typically, at this stage, I would say most would prefer to have advance payments or cash on delivery. Very less likely that you would offer credit periods. On the payable side, where you're sourcing material or sourcing finished product or any other type of sourcing, what type of credit does the vendor offer? Can we maximize that? That influences your payables. And in the case of a manufacturing setup, definitely what kind of inventory do I need to hold? If I have multiple SKUs, do I stock every SKU in adequate quantities and so on and so forth? So that's a policy one needs to look at. Essentially, one needs to see what is my cash operating cycle at the end of the day, which is nothing but inventory plus receivables, net of payables. And the cash flow gives you that information on a periodic basis. If you're doing it monthly, then it tells you where your operating cycle or working capital, net working capital position is. Just to look at some example again, this is again in the case of a manufacturing entity, you will have inventory, but in the case of a service entity, you may not have inventory. But if you look at the numbers, what it broadly shows is the first box is basically how many days you need to hold inventory, which is about 55 days. This is a hypothetical number. How many days it takes for me to collect money from my clients? It's 58 days. And how many days am I paying my vendors? It's 41 days. So essentially, I'm having an operating cycle of 73 days. But important to note that the longer the cycle is, the more pressure it puts on operations. So the key is to have as much as, what you may call as a negative, work towards a negative operating cycle, which essentially means that my payables is more than inventory plus outstanding, sales outstanding. However, if we do reach that stage, the onus is on the management or the entrepreneur to ensure that this is an excellent situation, but to maintain that is something which is a huge challenge. To close on the financial plan, basically what we are trying to say here is, as much as possible, try and project realistic and achievable numbers, because when the business plan or financial plan document reaches a potential investor, this is the first thing they're going to look at, is how realistic and how achievable are the numbers, whether it's top line, whether it's costs, whether it's cash requirements, all those. A question comes as to what is a good time horizon. I would say the typical need of a potential investor would be at least 3 years. 3 to 5 years is a good time horizon to look at to prepare a financial plan. It will be advisable to incorporate milestones in terms of saying that, okay, if I achieve a certain customer base or if I achieve a certain revenue number, I will trigger my next phase of expansion, or I'll look at geographical or product line extensions, and so on and so forth. So it's a good idea to incorporate milestones in the financial plan. Equally important is to see how am I going to fare in different scenarios. So what this means is basically what kind of a realistic scenario am I looking at? What kind of an optimistic scenario am I looking at? And what kind of a worst scenario am I looking at? So these are what ifs if, if my top line goes beyond what I have planned, then it's like a bumper kind of a achievement. So is that something which is something which I am comfortable with? Or is there something that could go wrong, and am I looking at the worst scenario? Once we do the scenario analysis, you're able to say, okay, confidently to an investor or a lender to say, yes, if this is my realistic scenario, this could also be my super scenario or best case scenario, and this could also be my worst case scenario. This, of course, comes up if there is a discussion of this nature. And in any pitch deck or in any financial plan, financials should be appropriate to the stage of growth, in the sense that if you already have a business, A, or if you have already borrowed money or have some amount of equity invested in the business, or there is traction, proof of concept is there are a few customers paying for revenue, all these can be incorporated in the financial plan. So it's not necessary that year zero has to start completely on a greenfield basis. So if there is some background to the financials, in reality, there's no harm in showing that as well as part of the financial plan. So having talked about the plan, I think it's important to note for any entrepreneur or any individual for that matter, that we have a particular plan in mind and things go very, very different on a day-to-day basis. There could be peaks and troughs. There will be highs and lows. But what a plan does is at least it gives you something to measure against. So here we are saying that if you have a plan, then you can actually measure your progress on a periodic basis. I would say if you're just starting, one needs to do it on a monthly basis. It's very easy to collate data in Excel, to say how many invoices have I raised, how many customers do I have, how many repeat customers do I have, what are my costs, so on and so forth. And once you reach a particular stage, then even a basic version of Tally gives you a good dashboard to tell you where you stand. It's important as we look at tracking that are we monitoring the key indicators? So for example, if my plan says that I will achieve X revenue on a monthly basis, or if I say that my MRR is going to be X by a particular timeline, your actual progress will tell you, are we in track to achieve our MRR, or even the ARR if we have projected that. ARR is nothing but the annual recurring revenue, and MRR is nothing but the monthly recurring revenue. Similarly, the cash position and the cost situation, these need very, very close monitoring. If you have the data, then some amount of financial analysis also helps, because some simple ratios like, what's my gross profit to revenue, what's my net profit to revenue, where are my DSOs, days sales outstandings, and see what trend is emerging out of it. Also critical is to look out for signals, because if you look at the key performance indicators, it will throw some signals at all points in time. So for example, what I have talked about here is my discounted sales at a very high ratio? Are my volumes not moving as expected? Or are volumes of certain items moving, but not in many other cases? So on and so forth. And so is there a course correction required at any point in time? Having talked about what the importance of a plan and the importance of measuring progress against a plan, the next 2 or 3 slides, I'm just going to give you simple case studies to tell you what warning signals look like. These are case studies, real case studies, but I have intentionally masked the name. It's not difficult for you to look out for these case studies. But quickly looking at 2 or 3 of them. Here is a marketplace which wanted to order for people to order groceries online at a cheaper price and delivery at as short a notice as 2 hours. The company received very good funding, but it failed. And it failed because two or three key reasons, and some of this I did talk about earlier. They spent a hefty amount to acquire customers. So customer acquisition cost in this case was very, very high. They ended up offering many products at a discount, heavy discounts actually. And more importantly, they were a zero inventory owned. So they were completely dependent on their sources of supply for not only information on inventory, but also deliveries in accordance with that. Here's another case, which is a subscription-based service, which I wanted to offer several dairy products directly at the customer's doorstep. But what they failed to read as signals was there, while the company was in existence for 3 to 4 years, in 2019, and this is really around just before, just after COVID, the month-on-month downloads started dropping, and they failed to look at those signals. And then compounded by low margins and excessive usage of cashbacks again, the company actually failed, thanks to intense competition. Here is another enterprise which was delivering educational content in various forms. Pricing was not abnormally high, but still high. But what they failed to do was to get a good reading of schools, one of their major customers, the reluctance of schools to accept their study material in the face of a lot of free stuff available on the internet, and leading players in the market actually gaining more and more popularity. And the last one is basically a company which wanted to offer a marketplace for pre-owned cars, but they didn't open up to car dealers, and that seemed to be a big setback for them. One of the key things that was missing in their pricing strategies, they could not assign standardized prices, much like, let's say, a Cars 24 is able to do today. And so slowly, the decline in key parameters led to their downfall. So with this, I'll take a break. Thank you so much. And we now open ourselves for questions and answers.
Great. Thank you. Thank you very much, Sridhar, walking us through the different aspects of financial planning. Particularly, I think the examples were very interesting. Any questions from any of the attendees? Otherwise, I will start with my own set of questions. Any questions, please post them in the Q&A box. While people are gathering the thoughts, let me just ask this question of you, Sridhar.
Yeah.
When one is starting out a business, right, there are a set of assumptions and everything else. And like you said, the plan always looks very smooth. It doesn't factor in any of the pitfalls or roadblocks or obstacles or challenges that we may face. And therefore, when one is creating this kind of a plan, how should one budget for or make assumptions for the inevitable problems and obstacles that might arise? In other words, do you suggest that we create different scenarios and model those? Do you look at, let's look at what is the most pessimistic scenario and then create a plan based on that? What is your recommendation?
Yeah, so this is I think a very crucial aspect of any planning process. Typically, what happens is, and I think I alluded to it to some extent when I spoke about scenario analysis. Typically, what we tend to do is when we create our plans, we focus on what we are going to achieve, what we want to achieve, and how we want to achieve. A little bit of a study across the environment to see what kind of experiences competitors have, or even similar enterprises have, will give some insights as to what are the things that could go not as per plan, or go awry, or go wrong. And so once we are able to gauge that situation and understand what are the likely pitfalls, that is when scenario analysis comes into play. Now, from an entrepreneur's point of view, one can do multiple what ifs. Even in established companies, when you launch a new project or you want to launch a new product, we do multiple what ifs to see, okay, if this happens, what will we do? If this happens, what will we do? And then we culminate that into a scenario analysis, which ultimately talks about three scenarios. So, which is the worst, realistic, and the best. So the what ifs is really what gives us the sense of awareness and comfort to say that, okay, I had estimated, let's say, I'm a tourism enterprise. I am expecting that during winters, all my packages for the summer location are going to be overbooked. But some unforeseen circumstances, it is not overbooked, it's just 70% booked. Now, if we look at it, if we look at our own indicators, so one is to see that, okay, this is what I'm anticipating may happen. I am expecting it to be overbooked, but there's a possibility that I might be underbooked. If I'm underbooked, what strategy should I adopt? So what if gives that kind of an insight to an entrepreneur to say, okay, in this particular situation, this is how I'm going to react. Similarly, in a product-based company, if I have 5 SKUs and I have 3 which are fast moving and 2 are not so fast moving, but I have planned that I will, I'm looking at all 5 moving at the same pace. So the plan tells you that, okay, I have projected this, but if I do a what if to say, okay, 2 of those may not be as fast moving as I thought, what should I do? So it gives some kind of a early preparatory kind of a scenario to say, in the event of this happening, how am I going to react? So basically, scenario analysis is a must. So planning is the first level. Then you do a scenario analysis based on what ifs, and then you prepare strategies or tactics to say, how am I going to handle it? So this is essentially what it is.
All right, thank you. So as the old saying goes, planning and preparation is important, not the plan itself.
Absolutely.
So the plan is subject to change and meeting the real world situation, right?
Yes.
A couple of questions have come into the box. One from Ajit Padmanabh. He says, given the realistic in smart, is a 3 to 5 year cash flow stay window feasible or realistic? Or should we look at a shorter time frame from an investor's perspective through what ifs? And there's one other question, let me finish that off here. Do we need a chartered accountant as a founder director? Else, if we have to provide for ESOPs, at what percentage? And how does one determine the KPIs of an industry? How does one vet it? So the 2 separate sets of questions.
Yeah. So to take the first one, yes, in today's world, compared to what we have seen in a decade ago, in today's world, a 3-year or a 5-year time frame does look, very, very unpredictable and unrealistic. So typically, what happens in today's world is that while I start with a 3-year plan, even my cash flow is worked out for 3 years. There is something called a rolling forecast, which people have started adopting. And so what we tend to do is, whether it's an established company or otherwise, every quarter, there is a rolling forecast revision, which basically says that I had anticipated or estimated something will happen over the next 12 months or 36 months. Q1 has shown something different, and hence I'm going to adjust my plan accordingly. So the same holds good whether it's a financial plan in totality or whether it's a cash flow. Many established companies, do an 18-month or a 12-month rolling forecast, which means once a quarter is over, they actually remove that quarter and then project for the next 18 months. So there are different ways of handling it. But yes, it is not a static plan. It is not a static cash flow. I think let's accept that. And today's dynamic world has actually shown that it cannot be static. So some amount of dynamism in the plan is required. And so whether it's quarterly, whether it's depending on the industry, the environment, one needs to keep updating and make it more dynamic. That's as far as the cash flow periodicity is concerned. As far as the financial plan is concerned, whether a chartered accountant or whoever, the way it works typically in today's world is, let's say a founder or a set of co-founders have a certain skill set, whether it is marketing, whether it's technical, so on and so forth. If they do not have a financial expertise or a skill set, a good idea would be to have somebody with that skill set into the, as a co-founder. In the absence of that, have somebody as a retainer or an advisor. So that addresses, so today there are options as to how you can get, and it is not restricted to financial, it is, applicable to every domain. So for example, if a founder is a complete technology person, he may want, a lot of marketing expertise. So there's a possibility that he may want to retain somebody on the marketing side. Similarly, or somebody on the financial side. Alternatively, if any of them are willing to join as a co-founder, that's also a workable option. Coming to ESOPs, so it's not, there's no ready formula for that. Now, what happens typically is, depending on what stage one is. So if, for example, if you are going to, if you're looking at angel investors, for example, or if you are just at the seed stage, you are not possibly having employees on your payroll. But when you're raising the first round of funding, one needs to keep in mind that I have to allocate some equity for potential employees joining, key management personnel, you may call them. Now, typically the initial round is, let's say, anywhere between 5 to 15% of your equity. One way is to negotiate with the potential investor to say, okay, part of this is going to be allocated for ESOPs, and the rest is what we are giving for the investor. So that's a formula which always depends on discussions with the potential investors. But yes, it's a good idea to keep anywhere between 2 to 4% as equity for ESOPs.
Okay, thanks, Sridhar. There's a question from Santosh. He's asking, how does one differentiate between CapEx and OpEx in an earning statement?
Yeah. So what happens is, if I go, let's say I need to, let's say, develop a platform, an IT platform, and it's going to cost me 50 lakhs of rupees. Now, one possibility is I treat it as CapEx, and what happens then is I get depreciation on that in my earnings statement. So what happens is, since I'm putting my money upfront in the form of CapEx, depreciation becomes a non-cash charge as far as the P&L is, or the earnings statement is concerned. A model which is more prevalent now, if I do not want to put upfront CapEx, or I do not have enough resources to put up upfront CapEx, is where the company, then the provider, you negotiate or have an understanding with the provider that the total cost will be spread over, because typically any of these platforms are also maintained by the same provider over a period of 2 to 3 years. So what you end up structuring is in a manner that you say, every year I will pay X amount, which is a charge to your earnings statement. So as against a depreciation, which is a non-cash charge, if you choose the OpEx model with the provider, you will end up having a cash charge in the form of, a cost of platform development or whatever in your earnings statement. Can't hear you, Sanjay.
Can you hear me now?
Yeah.
Okay. The question from Srividya. She says the spends for building a D2C brand is rather high, right? One has to go out, create the brand digitally and all that. What would be a good multiple, in your view, of the total spends that one should aim as revenue? So if I'm spending X rupees on my marketing, what kinds of revenues should I be looking at? Just approximate rule of thumb, particularly.
So today there is no real rule of thumb for customer acquisition versus revenue. But what is experienced is what is my customer acquisition cost? And customer acquisition cost or CAC is nothing but the marketing spends to acquire customers. So what is my CAC versus the lifetime value of a customer? So a lifetime value of a customer is, let's say in a year, the customer has purchased X amount of rupees. And I have spent, let's say, X minus something for CAC. The general ratio is that your lifetime value of a customer is generally seen to be at least 3 times the customer acquisition cost. So if you use this as a rule of thumb, then if you aggregate the total customer base, then you get a some kind of a revenue number. But otherwise, there's no direct correlation between CAC versus revenue.
And so let me, are there any more questions from the audience? Otherwise, I will ask one last question and then we can wrap up this evening's program. So Sridhar, my question to you is, what is your recommendation to the entrepreneurs, right? Because typically at what stage, because most of the time entrepreneurs do a lot of this in their heads, or they have a small Google sheet or something, right? Very rarely do entrepreneurs, at least from the time they start till the time they start growing, invest in, let's say, something like a Tally, right? And nothing, and let's leave aside anything more sophisticated. So the point is, what is your recommendation to entrepreneurs about how they should start thinking about this? Is just a piece of paper and a pen or an Excel sheet or a Google sheet good enough to start off, and what should they be focused on?
So basically, there is no compromise, according to me, on having some kind of data. So if we have to achieve that, I think an Excel is a wonderful solution because it offers you a lot of flexibility. It is a multidimensional kind of a spreadsheet that is available to you. There is no need to invest in a Tally early on. But if we are religiously able to capture all our costs and all our revenues, that itself is a great starting point. The third element I would say is, a cash flow in its raw form is fine, but what is the money that I'm receiving and what is the money that I'm spending? Now, one thing that we need to avoid is many a times at the initial stages, we confuse our personal cash with our what we intend to do as an entrepreneurial cash. So first thing is to split the two completely. Cut off any kind of individual versus or personal versus enterprise relations from a financial standpoint. What I mean here is, even if, let's say, an entrepreneur is offering office space to the enterprise, it's better to capture that as a contribution to the enterprise. And as the build-up starts, typically costs will be the first one to happen, and then comes revenue. So all types of costs, whether it is, if it's a production type of a company or a trading kind of a company where you're acquiring stuff and selling, or if you're manufacturing something, every cost that is incurred has to be captured in a cost sheet. Similarly, the money that is spent, that is paid out to a vendor or to a provider for every particular purpose, as far as the enterprise is concerned, has to be captured in a separate Excel sheet. So one file which says sheet A is for revenue, sheet B is for cost, sheet C is for cash flow. Again, the important thing is, at some stage, it's not possible that you are likely to come under the GST umbrella at initial stages, because the thresholds are very high. But at some stage, to get into that mindset of saying, where am I going to look at things from a tax perspective, whether it's indirect or direct, again, this will be helpful. So let's not shy away from capturing any type of revenue, cost, or cash flow right from the word go, and then build on it as we go along. And Excel is good enough.
Excel is good enough. One last question before we wrap up. For non-revenue generating startups, typically some valuation is done by an external, let's say, funder or investor. Now, how often do you suggest that this be revisited once revenue starts coming in? This question is by Ajit Padmanabh.
Yeah. So typically, the valuation done at that stage or the initial stage or at the seed stage, as you may call it, is very, very theoretical. Although there are methods available for valuation, they really don't result in anything scientific. It's just something to go by. But having done that and business having picked up and revenue stream having been generated successfully, at least after a year, one needs to probably revisit the valuation. If there is a need for funding, it's unlikely that there will be a need for funding before the end of 1 year. And that's why I'm saying if your revenue pattern is reasonably good, after 12 months to revisit the revenue, to revisit the valuation with a more scientific method is appropriate, because it prepares you for the next round of funding, which could be 18 months down the line. So when I mean 18 months, I'm saying 18 months from the first round of funding. So which means 6 months before the next round of funding, assuming 18 months is the gap between the first and the second round, is a good time to revisit valuation. And also, it would give a perspective on, if you have achieved better than your plan, then can you demand for more, so on and so forth. So 12 months is a good time. Can't hear you, Sanjay.
No, sorry, I was pressing the wrong thing. My apologies. So thank you very much, Sridhar, for that, for clarifying all the questions and for walking us through the financial planning process, and more importantly, how to start thinking about both sides of the financial statement, so to speak. And so thank you very much. Thanks for your time. I hope this was of use to all of you who participated. And all that remains for me is to thank the attendees again. I know it's a Friday evening, and I guess we have all started working. So wonderful. Thank you all very much. I hope to catch you soon in the next edition. Thank you.
Pleasure.
Bye-bye.
Thank you so much. Thank you, everybody.
Thanks.
Thanks,
Bye.
Sanjay.
Bye.